My mother almost lost $250,000. A lifetime of saving, nearly gone. All because of one ordinary mistake that millions of seniors are making right now without knowing it. Here is exactly what she did, so it never happens to you. That one mistake was simple. She kept a large amount of money in one account at one bank, the way most people are taught to their whole lives. And doing that quietly exposes your money to 3 specific risks at the very same time. I want to walk you through all 3, using what happened with my mother as a real example, because once you understand them, every one of them is simple to check and simple to fix. Let me start with her situation, because it will sound familiar. My mother was never wealthy. She had just done everything right for 50 years. She paid her bills, she avoided debt, and she slowly built a cushion so that she would never have to be a burden to anyone. When she sold her home, all of it came together into one number in one account. And every month, that number on her statement gave her a sense of relief. The problem is that the feeling of safety and the fact of safety are not always the same thing. And in her case, they had quietly drifted apart. The first risk is the one most people find hardest to believe, because it feels impossible that their own bank would leave them exposed. So let me give you the rule plainly. Federal deposit insurance protects the money in your bank account only up to a limit. Right now, that limit is $250,000 per person per bank in each ownership category. Any money you hold above that limit in a single bank is not insured. If the bank fails, and banks do fail, the insured portion is returned to you quickly and in full. The uninsured portion is not guaranteed. You become a creditor of the failed bank, standing in line behind others, and you may recover some of it, or none of it, and it can take years. Here is what that meant for my mother. A large share of her savings sat in one account, well above that line. As a simple example, if a person keeps $400,000 in one account at one bank, roughly $150,000 of that is completely uninsured. That money sat exposed for 4 years, and no one at the bank had any obligation to mention it, because being over the limit does not break any rule. It was simply a risk she was carrying without knowing it existed. The good news is that this one is easy to solve, and it is worth understanding how, because the same rule that creates the risk also hands you the fix. That $250,000 limit applies for each ownership category, and there are several categories that stack on top of one another at the same bank. An account in your own name is one category. A joint account with a spouse is a second. A properly set up trust account, naming the people you want the money to go to, is a third. Each one carries its own separate $250,000 of coverage. So a single person using an individual account and a trust account can protect far more than the basic limit. And a married couple using individual, joint, and trust categories can be fully insured on well over $1 million at just one bank. And if you simply move some of the money to a second or third bank, the protection begins again from zero at each new bank. There's also a free tool offered by the agency that runs the insurance that lets you type in your accounts and see exactly how much of your money is currently protected and how much is exposed. It takes about 10 minutes, and most people have never once used it. My mother had never heard of it. The second risk is quieter, and it affects almost everyone, not just people with large savings. Money sitting in a checking account or in a basic savings account usually earns very little interest, often a fraction of 1%. Meanwhile, the cost of living rises every year. When the interest you earn is lower than the rate at which prices are climbing, the real value of your money, its actual buying power, falls each year, even though the balance on your statement never changes. This is the part that fools careful people, and it fooled my mother completely. She watched the number held steady, and so she assumed nothing was being lost. But consider what happens over time. If prices rise even a few percent a year, and your money earns almost nothing, then a large sum sitting idle for 4 or 5 years can quietly lose thousands of dollars in what it can actually buy, without the statement ever showing a single dollar leaving. The fix here is not to gamble the money in the stock market, which carries its own risks that most retirees do not want. It is to move the money you do not need for daily living into options that are still safe, but that at least keep pace with rising prices. A high-yield savings account, a money market account, and a certificate of deposit are all still covered by the same federal deposit insurance, and United States Treasury products are backed directly by the federal government. Any of them can protect your money while it earns a reasonable return, instead of letting it sit still and slowly shrink. The third risk is the one that can turn a simple mistake into a genuine legal problem. so it is worth understanding exactly. By law, banks are required to report any cash transaction over $10,000 to the federal government. That report is automatic, and for honest money, it is nothing whatsoever to worry about. The danger is in what some people do to try to avoid it. Breaking a large deposit or withdrawal into smaller amounts, specifically to stay under that $10,000 line, is a federal crime. It has a name. It is called structuring, and it is illegal regardless of whether the money itself is completely legitimate. The penalties are serious, including heavy fines and even the possibility of prison, because the law treats the act of deliberately hiding the transaction as the offense, entirely separate from where the money came from. My mother nearly did exactly this. When she needed to move a large sum to help one of her grandchildren, a well-meaning friend advised her to split it into several smaller amounts over a couple of weeks to avoid the paperwork and the attention. She was not trying to hide anything from anyone, but the pattern of splitting a transaction to stay under the line is precisely what the law looks for. And ordinary, honest people have had their accounts frozen and investigated over it. The correct approach is simple and completely safe. Move large sums in the open, in a single transaction, and let the automatic report happen. Honest money has nothing to fear from that report. It only creates a problem when it looks like it is being hidden. So let me put the 3 fixes together plainly, because this is the part you can actually act on. To close the insurance gap, spread money across more than one bank, or use the separate ownership categories at a single bank, and use that free coverage tool to confirm that every dollar is protected. To stop the quiet loss of value, move money you do not need for daily expenses out of a near zero interest account and into safe, insured, or government-backed options that keep pace with rising prices. And to avoid the reporting problem, never split a transaction to stay under the limit. Move money openly, in one piece, and there is nothing to worry about. There is one more point that is easy to miss, and it matters. This is not something you set up one time and then forget. Insurance coverage can change if you move money, add a name to an account, or if your bank merges with another one. Interest rates shift over time, so an account that was reasonable 2 years ago may be paying almost nothing today. For that reason, it is worth doing a simple review about once a year. Check where your money sits against the insured limit, confirm it is still fully protected, and check whether it is still keeping up with the cost of living. It takes a few minutes, and it is the difference between setting up a plan and actually keeping one. The thread that runs through all 3 of these risks is the same, and it is the reason I wanted to lay them out so clearly. None of them are the result of doing something wrong. They are the result of doing the ordinary, careful thing, keeping a large amount of money in one place, without knowing the specific rules that quietly apply to it. And the institutions involved have very little reason to explain those rules to you, because in each case, the very arrangement that puts you at risk is the same one that works in their favor and against yours. So here is the practical takeaway I hope you will act on this week. Look at how much of your money, or your parents' money, is held in one account at one bank, and check just 2 things. Whether any of it is sitting above the insured limit, and whether the money you are not actively using is earning less than the rate that prices are rising. Both are quick to check, and both are straightforward to fix. And if this was useful to you, please pass it along to someone who keeps their savings in a single account. Because the reason this keeps happening to careful people over and over is simply that no one ever took the time to explain it to them. A brief closing note. This is general educational information, and the specific limits and rules can change over time and can depend on your own circumstances. So use your bank, the official insurance tool, or a qualified professional who has no stake in where your money sits to confirm exactly where you stand. The goal here is only to make sure you know which questions are worth asking before another year goes by.